Overall, July has been a much better month in the markets, and August is looking to follow the same pattern. Could the bear market be over? Are we looking at better days, or is this just an eye in the bear market hurricane? To answer this question, we need to take inventory of where we are and look into where we are going, and we will begin that right now. The Standard & Poor's 500, or S&P 500 as it is more commonly called, is a list of the top 500 companies by market capitalization. For roughly every $9 billion in market capitalization, we get one S&P point. So on January 3rd, 2022, the S&P 500 was at 4,796.53. That roughly works out to $43.168 trillion. I can see why it is easier to work with the smaller S&P 500 points. On June 16th, the S&P 500 was at 3,666.77. It had fallen 30.8%, placing us well into bear market territory. The first half of this year has been rough as we've experienced a sea of red. However, what has happened since June 12th? We have been in a bit of a recovery as of late. At the time of recording, the S&P 500 has risen to 4151.94, which is a rise of 13.3%. The market is looking green lately, and that has brought a little hope back to people. Overall, we are still down 15.4% this year, but could that mean there is hope? Can we be on our way to a new high in the S&P 500 and thus an end to the bear market? Before we answer that question, let me know in the comments below when you think we will see an end to that bear market. If you are not subscribed to the channel, slam that button now so you can help the channel grow and keep the flow of free financial content flowing your way. Earlier, I asked if we are maybe looking at the end of the bear market. Before I answer that, always remember that nobody truly knows the future, and as soon as you are talking tomorrow or next week, you are in the land of speculation. No matter how good and grounded your prediction may be, all it takes is a black swan event to completely turn a smart prediction into a cheap horoscope level of accuracy. Nonetheless, let's see if we can build that smart prediction. The general market conditions we are experiencing in 2022 are without doubt influenced by two major factors: the world's response to the pandemic and, of course, Russia's invasion of Ukraine. With the pandemic, the initial shock in 2020 caused the US to fall into one of the shortest recessions on record and left a massive crater in the price of most assets. At the glance of the 5-year chart for almost any stock, you can pick out March 2020 without even looking at the dates. This was followed by massive stimulus, which was powered by crazy levels of money printing. A lot of this money made its way into the market, and we had a massive bull run for the rest of 2020 and 2021. One question you have to ask: did that infusion of free money into the market overvalue everything? A lot of people will say that it did. However, does that actually make it true? Instead of opinion, I prefer to let math answer the question for me. If you look at the S&P's average growth over 2018 into 2019, so the 2 years before the pandemic, it was growing at 8.95% per year. If we extrapolate forward from January 2020 to January 2022, that would mean the S&P 500 without the pandemic would have been around 3839.80. That is quite a bit lower than the 4151.94. That market was actually 8.13% higher than what we were expecting. Averages, though, there does need to be some amount of standard deviation. The longer-term average of the S&P 500 is actually a little bit higher at 10.67%, and for the standard deviation, we do need to use that number as our data point. The average standard deviation for the S&P 500 is 15%, which means that typically you can expect the return to range from negative 4.33% to 25.67%. That is a pretty big range, and when you factor in the bear markets and the more common bull markets, the way it skews does make a lot of sense. All right, the point is that the 8.13% higher than expected number is within standard deviation. This does not negate the money printing effect on the market at all, because the average standard deviation would be much smaller if you excluded past bear markets. In 2019, the standard deviation came in at roughly 10%. Yes, we are still within the standard deviation, but being on the high side of that range is obviously not a coincidence. The money printing has caused some share price inflation, but it is by far not the most important factor in the collapse of the market. The supply chain issues and labor shortages began to create some serious issues for many companies that rely on manufacturing. Chip shortages began to shortchange the number of products many tech companies could fulfill. The money printing, in conjunction with supply chain or labor-induced shortages, were creating the perfect storm for inflation, which began to show itself in 2021 and then began to become much more serious in 2022. Throw in Russia invading Ukraine, and the supply issues grew as Ukrainian food exports came to a halt, and many supply chain shortages became a real lack of supply issue. Everything came to a head in 2022, and the market was set up perfectly to descend into a bear market. Inflation was pulling money out of the market, and rate hikes used to fight that inflation was also making it harder for people to make ends meet, and thus investments made in the good times were being used to survive the bad times. The outflow of money was absolutely going to impact the market. In terms of tech, not being able to produce products to meet demand due to shortages of chips and other components was adding extra misery to the sector. Also, the fact that a lot of the pandemic money made it into tech, they were seeing more come out, and their overvalue was really beginning to work against them. Of course, when you add all of this together, this is how we got to June 16th and that 30.8% overall drop in 2022. But why June 16th? What happened on June 16th to halt this slide? It was the American Fed announcing a 75 basis point hike in their benchmark lending rate. The S&P 500 had already priced this in, and when the Fed gave exactly what the market wanted, it experienced a very positive change. We saw a 2% rally on that day. The rally, of course, did continue, and it persisted through the end of June, into July, and now into the beginning of August. The Fed also hiked the rate again by another 75 basis points on July 27th. And once again, it was exactly what the market priced in, and the market responded well to this. In fact, when the Q2 GDP results came in negative, which indicated a technical recession, this did not face the market at all. The fact that the Bureau of Economic Research has yet to call an official recession has also added a lot of positivity to the market. This takes us to today, and for reference, I am filming this on Friday, August 5th. In the morning, in anticipation of today's jobs report, we did see a little bit of red creep into the S&P 500, and it looked like we may be on the verge of a red day. However, that jobs report is really not that bad. In Canada, it's worse. We lost 30,600 jobs in July. But in the U.S., the U.S. economy actually added 528,000 jobs in July, which is double what was expected. And unemployment also dropped from 3.6 down to 3.5%. The strong jobs market is one of the reasons an official recession has not been called. So where is this going? Do we have a chance to keep the rally alive? I do personally believe August will be a lot like July, with some good recovery. That will more than likely make it into the first week of September. However, I do not think it is going to last. The issues that have caused the bear market have not been resolved, and some are more than likely to get worse before they get better. I do hope that I am wrong, but all signs point to a resurgence of the bear market in the fall, and that may be a best case scenario. If this rally persists deeper into September, October, or even November, I fear the other side of the bear market will be that much more painful. The bear market and the likely coming recession will be with us for a while. It is not a time to lose hope or to embrace false hope for that matter. The worst thing people can do right now is get caught up in the fear of missing out feeling that this rally can create. If you are buying now, then selling in the fall when the bear crushes your hope, that is a pathway to losing a lot of money. Dollar cost averaging is always the best way for long-term success in the market. Even though I think we are in the eye of a larger bear hurricane, I can be wrong. We can all be wrong. If you hoard cash for the back half of the bear market, and we are all wrong, then you have missed out on the buying opportunities that were the first half of this year and the rally while prices were still discounted. A dollar cost average strategy hits both of these markets and will make a lot more money in the case that we were all wrong, and that, of course, is the true power of dollar cost averaging. My personal strategy is using this rally to rebalance some of my portfolio. I was way over diversified into CNR, so I took some profits and then DCA'd those into other assets to move my portfolio closer to where it should be. I am by no means saying you should do the same, as that was just something that made sense for my portfolio. To find out what makes sense for your investing strategy, it will take a lot of research on your part to figure that out, and you may even want to talk to your financial advisor once or twice as well. When the bears begin painting the market red again, take solace in the fact that the purchases you are making in a bear market are some very nice future profits. This doesn't have to end here. You should check out my video on Timber Creek Financial, or you can try the video YouTube thinks you will like more. You can decide who's right, and I'll see you in the next video.